Hi, been such a long time. Welcome to ET now.
I know, Aisha. Good morning, and thank you so much for having me. And you're right; it has been a long time, and I think COVID has taken a toll on everybody. But I'm really happy to be back.
Nikunj and I were just reminiscing, Ramesh, that actually today is the 2-year anniversary of when Nifty hit that COVID low of 7,500. I mean, in just 2 years, we've been to the moon and back, and look where we are right now, and look where the world has moved. We're almost towards the end of COVID, and now we're worrying about oil, war, completely different landscape than what we were in 2 years back.
I mean, you're absolutely right. I think the enduring lesson, of course, is that long term to create wealth is to remain in equities because you're right. We've been through a health scare, and now we've been through a war, uh, rampant inflation, and despite all this, the global indices are close to the all-time highs. So it tells you equity is a good place to park your money.
So good to have you back, and so nice to connect with you. And I just want to make this point for the benefit of our viewers. I mean, it's such a pleasure to interact with Mr. Damani every time. And if I have to make a list of some of the finest investors of his generation, not my generation, Ramesh, your generation, not my generation, I think your name clearly would be there on the pedestal. So nice to have you back. So every time when
You're too kind, Nikunj. You're too kind. Thank you so much, and it's thank you for those really high praises. I'm not sure I belong there, but I'll accept it. Thank you.
now the difficult part, which is that everybody knows that Ramesh Damani rarely comes on TV, but when he comes on TV, he has to say something new, different, and he has to share some money-making ideas. How do I solve this puzzle?
Well, let's start this way, Nikunj. Let's take my view on the market. I mean, the question we ask ourselves and investors should ask themselves is, should we sell the rallies or buy the dips? And increasingly, my understanding of how the market is behaving is the right course is to buy the dips, which suggests that we're in an ongoing bull market. Why do I say we're in an ongoing bull market? I say that because you look at how market reacts to news. It gets such bad news from the Fed, from oil going up, from Ukraine. It shrugs off the bad news and starts moving higher again. So my sense is that the market wants to move higher. Having said that, I think for the next 3 months, 6 months, I would have assumed in January this year, if you asked me, the market would take out its old high of 62,200 made in October 21. But I think it's going to be delayed. There's just too many headwinds going on right now. But I still believe, what I realized over the last 30 years, that if you try to time the market, trying to be too cute in the market, you're probably going to get the short end of the stick. So it's probably better to remain invested. And even if I don't see a market making a new high for 6 months, I think it's a good time to buy Indian equity and a good time to remain invested. So I'll answer your question this way, that I remain bullish. I think returns for the next 3 months, 6 months will probably be subdued because there are too many headwinds. But I think longer term, the bull market that began in, say, 2019 September is still intact and going strong.
Gravity. And guess what, Ramesh? Interest rates are likely to go higher, whether it is locally or globally. If the force of gravity is at play, why should equities outperform?
It's a good question, Udayan. I think you're absolutely right. I'm sorry, Nikunj, I'm so sorry. It is going to go up. I know, the Fed has almost blood in its eyes when it's talking about inflation. That's its mandate. So they've also signaled they might even raise interest rates by 50 bips as opposed to 25 bips, which the market is expecting. So why is the market going up despite that? Because interest rates are going from an abnormally low place. They were at 0%, they go to 2%, which takes them back to what they were, say, maybe in 2015, 16. So it is a sign of a resilient economy that can deal with higher interest rates. And I think it's good that you're weaning off this complete zero rate interest rate policy, but it will completely affect the valuation of all asset classes. And I think the market at this point is not yet discounted completely, though it knows that it's going to happen. It's not discounted the fact that interest rates are probably headed sharply higher in the US. And that means there will be a period of adjustments for equity, particularly the high value, high flying stocks if you have interest rates at zero, everything seems interesting, Nikunj. Every business proposal seems interesting. Now they'll evaluate it more closely, and then the market will swing from growth to value, because value stocks with dividend yields are still, plentiful in America also. And I think they will probably be the quadrant where investors will focus on.
I guess your theory of good news and good price rarely comes together. It was beautifully applied in March 2020, and even in March 2022, markets went below 16,000. There was peak of pessimism, oil at 130, war at its peak, Fed increasing rates, and markets bottomed out.
Absolutely. You're absolutely right, Nikunj. I think March 20th was, a case study. I mean, I was as shaken as anybody else in a dealing room on March 20th during the heat of the pandemic. And I would never have figured that the new bull market would be born at that time. But it just simply proved the adage that, when prices are rock bottom, the investment climate is very good. And that clearly proved itself out. Having said that, I think the market is sensing an opportunity beyond the pandemic in India particularly. I think what started, Nikunj, if you will bear with me, is in September 2019, when the Modi government cut corporate tax rates to 25%. You remember Trump had done the similar thing in the United States, and that led to a multi-year bull market in America. I think something similar is happening out here. This China plus one policy that the world is adopting, more resilience of supply chain from India, lower ease of doing business from India. All these things are helping. I think typically when bull markets start, we're unsure about the reasons bull markets are starting. But as the bull market extends in years, it becomes more and more clearer. And I think we are now becoming clear that the Indian economy is going to take center stage over the next few years. And the bull market is perhaps a recognition of that.
Indian markets do what, let's say, US markets did in the last decade, which is they moved independently of what was happening in the world between 2010 and 2020. What we saw was like a epic textbook bull market in US equities. Will that happen in Indian equities in this decade?
I like to think yes. I'm firmly in that bullish camp. After being very shaken during 2020, I've been shaken, I've been stirred, to use that old bond line. But now I firmly believe in this bull market hypothesis that, some of the money is now exposing in the Dalal Street. And I think you take a look at, Nikunj, in 2008, the market, in the global financial crisis, we sold $20 billion of equities, the foreigners, market fell 70%. Today, you had comparable amount of selling and the market's barely down 8 or 10%. It shows you the bigger story that the locals know better, or perhaps the bull market knows better. So I am thinking that we might have subdued gains for the next 6 months or so because of just such enormous headwinds with inflation, with oil prices, with the Ukraine situation, and that Ukraine situation can really get out of hand. And if Ukraine is solved, we can also start worrying about what's going on in Taiwan with China. So these are two geopolitical situations that are, going to absorb the market's interest for the next year or so. But I don't know why. I feel that it's a buy on the dips market, that you should remain invested. And I can only tell you what the last 30 years have taught me. When I started, the index was barely 600. Today it's closer to 60,000. The index has gone up, 100x in the last 30 years or so. I think India's economic renaissance began on July 1991 when Manmohan Singh presented his budget. And after that, it's been a pretty silly idea to be short India. I think over time, markets and good companies have found their way higher. So I firmly believe that the next 5 years, 10 years will be as attractive as the last 30 years were in India.
Everything, all the financial narrative right now, Ramesh, is centered around inflation. There are different views. What is your view on inflation?
I started that it was in the transitory camp, and I still think we're perhaps in the transitory camp. See, the Fed has seen blood on inflation, and they are now throwing the book because they cannot be seen to be behind the curve on inflation. But I think while in America we've had a supply and demand shock, which has led to inflation, in India it's not necessarily a supply and demand shock, just mainly a supply shock. Let's take oil, which is perhaps one of the biggest contribution to inflation pressures. India is much better suited to tackle it today than we were in the 90s when we started our journey to integrating with the global economy. And the reason I say that is that we export maybe $200 billion worth of software and import maybe $100 billion worth of oil at about $100 a barrel. So, we are well cushioned against that impact, if you will, because we have such good, software export. Indian demand hasn't still taken off yet, much to my chagrin. So that will keep some lid on inflation. Globally, food prices are going up, chip prices are going up. It is a problem. But for 40 years, what has happened is that China has been able to export deflation back because of lower price of Nike goods, Apple goods, textiles, whatever have you. And once this mess sorts itself out, I think the globalization that some people are writing off will probably reassert itself, because it's the model that works for everyone. It brings peace and prosperity, uplifts living standards. So I think maybe in 6 months, we will return to a rules-based international world order system. I think Russia will, pay a price for the aggression in Ukraine. But I think in the near term, for example, the other risk that I think we should start thinking about is a cyber warfare type of situation. I think Russia clearly, the army has not been proven very effective, but they're very talented group of software professionals. So they could gridlock, energy systems, satellite communication systems, telecom networks, which could, of course, lead to panic buying of all sorts of things. So I think inflation is a problem as I speak to you right now. But I think in 6 months' time, inflation will start coming down. And that is why I believe that the 10-year in America is still not reflecting, more inflation than maybe 2.5% or so.
The money over the years, when he's invested and when he's spoken on various forums, he's always used the importance of 3 words: power of compounding, margin of safety, and buying stocks when they're cheap. So I'm going to address all the 3 with you, sir, one by one. For
Of
this
course.
decade, what do you think would be the classic compounders? And I'm just putting some context for the benefit of our viewers, Mr. Damani, which is that IT has been a classic compounder for us. Private banks have been a classic compounder for us. What do you think would be the classic compounder for next couple of years in India now?
I mean, sector-wise, if someone asked me to put a new portfolio together as of today, it may not reflect exactly my own portfolio at the current time, because that's been built over 30 years. I would say the 2 broad swaths that you would want to have stocks in are, of course, technology. Someone pointed out to me that, China made the physical world. India is going to make the digital world. And everyone I meet increasingly realizes that they want remote working, they want digital work. So I think I would put 30% into technology. Also, if you look, you talked earlier in the show about the pandemic. And if you look at a 2-year view from 2020 to 2022, which stocks have done the best? I think among the top 10, 12 stocks, there must be at least 5 mid-cap technology companies: KPIT, Mastech, Tata Elxsi, Intellect Software. So technology is where it's at. It's, India's great boon in life. And even at these valuations and even at this time, I would not hesitate to put 30 to 40% in technology companies, some large cap, some mid-cap technology stocks. The other stock, which is, of course, more controversial, the other sector, which I tend to like a lot, is, of course, the public sector stocks in India. And you have a good, interesting array of choices. I mean, I'll give you an example. People often have criticized, PSUs as not delivering returns. But the stock you and I have talked about many times, because Bharat Electronics, the stock was a 300 crore market cap in the early 2000s. Today it's closer to 50, 60,000 crores. And the dividend yield in the stock, I mean, if you bought the stock maybe in 2003 at about 40 rupees, the dividend yield you get on the stock is perhaps equal to the stock price at that time. So, these are extraordinary businesses available. So within that, you could buy some commodity companies, you can buy some PSU banks, or you could buy what I have bought primarily is overweight on the defense and railway companies, because I find them extraordinarily cheap at the current time. So as you said currently, that I also have a margin of safety, and I believe the growth potential of these businesses are far superior than the market understands at this point. So I would say those where I put 60, 70% of the money. The rest you could buy in telecom, you could buy in chemicals, you could buy in pharma. I mean, there's just a plethora of choices. As you are aware that India is a stock pickers market. And I think you get, lots of choices. I would venture and be brave and say that investors, particularly if you're young in India, you're 25 years old, 30 years old, 35 years old, you need to be not invested 50% in equities and 50% cash, but I think upwards of 90% at this time, despite the headwinds I've seen, because I think you can try to be too cute and time this market, and invariably you will see a pandemic coming and get out of the market and not make the returns that happen in the next 6 months. So I would suggest to the younger crowd that you need to put 80, 90% of your wealth into equities at this point.
Ramesh, there was a time you were buying stocks to create your nest egg. Then there was a time you started buying stocks for Ashok, your son. And I'm sure now when you're investing for your 2 grandchildren. So
Yes.
let's divide what you're buying. We know you've created your nest egg, but let's say if you have to advise your son and if you have to make a portfolio for your grandchildren, how would you be differentiating there?
Great question, Nikunj, which I'm actually doing. I think, there's always when, someone new comes into the family, there's new thinking. And my son has also now started influencing my thinking. He's also now, a good practitioner in the markets. And he's been very bullish, for example, on the, the sporting business in India, particularly looking at the IPL, what a rage has become, and the valuations that the TV deals that could happen next month will go at. I think the last set of deals went at about 16,000 crores. This time, I think he feels that go upwards of 40, 45,000 crores. So how do you play that? You can either play that through the media businesses, or you can play that through the IPL franchises. And there are lots of ways you can play that. Some are listed directly, some are unlisted market. So he's brought that kind of thinking into my thought. But together we've tried to design a portfolio for my grandchildren and his children that, they could enjoy the benefits of compounding that I enjoyed. As I've often told you, the earlier you start, the better off you are. So we're really taking this advice to heart, and they're barely 4 and 2, but I've started to invest for them. So what I've invested for them is a mixture of companies that are very stable dividend yields and also some long shots. Unfortunately, I can't mention names, but there are some companies that either will be a 10x or won't do anything at all. So we put some of those baskets, and some more traditional companies, which in the financial sector, which we feel have a good growth ahead of them. Some large property companies which we feel will continue to do well in any environment. But it's been an article of faith with me, and I keep telling this to other people also, that people in my generation are old and close to retiring, but it's time to invest for your grandchildren, and they need. If you start now with small amounts, the money doesn't matter right now. You put in 10 lakhs, 20 lakhs, whatever amount you can afford to put in for your grandchildren. But if you do it correctly, if the money compounds over 30 years, by the time they reach college age or their marriage age, they should already have a substantial nest egg. So I really appreciate your question, because that is something that has been engaging me also for the last few years.
Who says you're too old? Buffett's made some of his most fantastic investments and his biggest bet in Apple after he turned 80. So maybe the best of Ramesh Damani is yet to come.
I hope so. I am very hopeful. But as you correctly pointed out, the pride and joy is now doing it for the grandchildren or doing it for other young kids who come to me. I think, there is some satisfaction giving back. Why not? I hope the best is yet to come.
And this is the point I just want to bring out for the benefit of our viewers. In hindsight, we've interacted with Mr. Damani, and I've had a great personal equation with him. So I know the way he's invested over the years, and he was amongst the first to call out the IT boom in India. Now, Ramesh, what you called out 20 years ago was a services boom in India. But now what has happened in the last couple of years is what is called as an internet and a tech boom. I'm sure not every company will survive, but the ones they will survive perhaps will hit it out of the park. You could have a Tesla in making or Amazon in making. How does one differentiate? Because you can see the growth there, but you can also see this absolute mispricing by the market when it comes to some of the Zomatos and the Paytms and the Nikas of the world.
You're right. Again, Nikunj, I would, in that portfolio, the mock portfolio I suggested, I would put a large amount of services businesses in there, because these are stable bread butter businesses, and the world desperately needs India programming talent now. So having said that, should you look at the fintech companies? Should you look at the e-commerce companies that are going there? I think you should. Just even example of a stock that I don't really own, but Zomato. It's a great business. They're expanding the market place in India. They do an extraordinary delivery service. It's just the valuation I can't stomach. I mean, the valuation that came out with, even though it popped on IPO, I could not store it. But so these businesses, the Nykas, the Zomatos, I think you should keep your eyes and ears open on their valuation. And at some point, the valuations will come to where the levels is attractive. I think these businesses are here to stay. I would not treat them all with the same brush. Some of them, make no sense to me, so I would avoid them. I don't know how to guide you more without discussing individual stocks, but would I look at some of them? Yeah, I would definitely look at a Zomato or a Nykaa, but I would wait for my price. They're nowhere near the price where I think they are really attractive out there. I think also, to be fair, I think brick and mortar will continue to do well in India. I have some insight into those businesses, and I think it's silly to assume that brick and mortar will be relegated and everything will be overtaken by tech. So I think it's a good place to be in technology, but you'll have to pick your new tech companies a bit more carefully.
My next question may get you into trouble, so I'm going to warn before I phrase my question, which is that how do you see the shape of retail changing in India in next couple of years?
I will respectfully, because of my positions in many sensitive boards in the retail space, avoid the question because it's just better this time. You don't want to get into regulatory trouble. But I think broadly as a sector, I think there's just enormous opportunity. And I think everyone it's like rivers flowing and you pick two buckets and, everyone has two buckets to pick. There's nothing there. So I think organized retail is in the nascent stages. And I think my particular sense is for retail trade, there's enormous headroom here. And it'll be both in brick and mortar and in e-commerce.
I want to go back to that whole part of tech investing, because that in a sense has been one of your core specialization. Identify businesses which are high growth and which can grow exponentially. Now, investing into an Infosys and TCS perhaps was easy because those were cash generating machines and they were giving a lot of dividend. They had a real PAT. Currently, some of these businesses do not have a sense when they will turn profitable. And that's when a classic investor like you or Mr. Junwala comes in, who says that, look, investing is all about understanding cash flows. So how does one deal with this kind of a conundrum?
I think you want to see a path to the cash flow, Nikunj. I think it's very important to, believe that there will be just more than, market share of a business at a particular point in time. I think if you look at what I would guide your viewers to is, if you do what Ramdev's last study, which he did in his wealth creation study, he pointed out how digital businesses are created and how they get market share and how they get profitability. And I think we need to kind of understand those businesses over a period of time. It's just that the rate of change in India is not as enormous as it is in America, where you can get penetration, of cell phones or penetration of e-commerce sites, go from 0 to 100 million in a matter of say 18 months or 24 months. I don't think it happens quite that fast in India because the credit market is not there, the courier market is not there. There are lots of impediments to that happening in that place. But I think there's enough body of evidence that suggests that these companies that have good business models, say positive contribution margins at this stage, will become cash flow positive in the next 2 to 5 years. And there are enough businesses of that. I can't take names, but there are enough businesses like that. It's just, I'm telling you, Nikunj, the problem is the valuation. You talked about Infosys and how we made money in Infosys. And I never get tired of reminding that Infosys came with an IPO in 92 at a 30 crore market cap, which even at that rate of 30 to the dollar was about $10 billion US. And it was already earning 3 to 4 crore rupees when it went IPO. Now you fast forward 30 years, these companies are coming at almost stratospheric valuation. So at least for people like me who value investors, I think there are better bets elsewhere. But I like these businesses. And as you are well aware that a great investment is also a great investment if bought at the right price. So we'll wait for the right price.
Ramesh, you always maintained that India is about betting, or the romance of India is consumer, and the advantage of America is technology. How do you see the frontline consumer companies moving? Because that is your direct play for our viewers to buy the Asian Paints and the HULs and the Nestle of the world. How do you see that space moving? Because, like you've said, that India is all about this consumer romance, isn't it?
I mean, I don't know. A lot of people have been negative right now on consumer discretionary. Maybe demand has taken a knockout. I remain bullish. I mean, the stocks that I've held, and I've held them now for 20, 30 years in my portfolio, practically unchanged. The levers of the business, the Daburs of the business. I've held them for 30 years, and I intend to hold them. I have no really great desire to sell those businesses at this point. I'll tell you the one aspect that I would worry about, at least, just to add some more context to the FMCG business, is increasingly I've seen that private labels are also taking share away from the branded companies. Private labels are just doing as good a job as some of the branded companies. So they are incrementally taking market share. So the margins of these FMCG companies could be affected over a period of time. We'll see this transition has just started. So we'll see how this plays out. But increasingly, and coffee, tea, hand wash, a lot of items, retailers are creating a private label brand. And, they could be taking market share away, keeping a pressure on prices for the FMCG companies. So that's the trend I worry about. But I would still suggest a good exposure to, consumer discretionary in my view.
Screen, ITC is up. State Bank of India is outperforming HDFC Bank. Kotak is underperforming, let's say, a Canara Bank. Are markets rotating? I mean, after years and years of, let's say, growth at any cost, it's going to be classic value, which is enterprise value. Look at market cap, look at debt equity. Is the market rotating?
I think so, because if you're seeing interest rates go up, when interest rates are zero, you want to invest in the most exorbitant growth story in the hope of a big jackpot 5 years down the road, because money doesn't cost you anything. But when money costs you something, when you pay something, you measure it more stringently. And I think that is the rotation that we're seeing right now globally. Yes, tech has had a rally for the last few weeks and they've come back a little bit. But I think, how can you ignore interest, dividends? How can you ignore cash flows? I mean, it just seems silly to me. Market for the last 2-3 years have been ignoring that. And that's partly the case I'm building for the public sector stocks because they have such clear order books. There's so much visibility. The government is committed to a capex cycle for the defense, for the railways. Okay, so here you have this extraordinary collection of businesses which are fairly dominant in the sectors they operate in. Available in the market at P's of 6 or 7 and yields of maybe 5 or 6%. 5 or 6% yields. I mean, I have to catch my breath when I say that to you. In a fixed deposit, you're getting 4% interest, and in a dividend stock, you're getting a 5-6% yield. And I can build a basket of stocks at about 5% yield. So it seems ridiculous to me that the market would, keep ignoring these stocks. Having said that, am I disappointed with the disinvestment policy? I'm a little bit disappointed. I think with the Prime Minister's office's weight and prestige behind it, I thought it would go a bit faster. But whatever, other than Air India, really nothing really has been done. We keep hearing that will happen, but, I think the delay is getting a bit too much for my taste. But I'm buying these businesses not because they will be privatized, because they may happen to be great. But I'm buying these businesses because they're essentially good businesses. The corporate governance in these businesses are increasing, and they're actually literally throwing away the valuation in these businesses. So, this is my contrarian bet, if that makes any sense.
You've been very kind with your time today, so I promise I'll not extend my appointment beyond 2-3 more questions. But this is for the larger audience, because a lot of first-timers who've come after COVID, they've felt the heat of volatility for the first time in last 60 days. 2020, if you came post the COVID crash, and 2021, if you remain invested, it was almost like an honeymoon period. Now the real volatility has tested you. what would be your advice to those? And there's a very large audience here who want to hear from you.
Again, thank you so much for that question, Nikunj. My advice is actually very clear. It's distilled from 30 years of experience in the market. Is that if you are young in India and India is a young country, you need to remain invested in Indian equities. And volatility is the nature of the beast. It's going to happen. You cannot do anything about it. Stocks will go up, stocks will go down, and stocks will go down 30% for no reason at all. Okay, and you still have to, ride through that period of volatility. Now, when we started our careers in the late 80s, the index was 600, 800, something like that. You decide which year you started in that. But look at the journey we've been through over the next 30 years. It's been almost 100x on the index, and that doesn't include dividends. So I'm saying the next 30 years promises to be, in my opinion, somewhat better than the last 30 because there are more, technologies allowing more companies to come into India. Innovation is happening. The Indian market is exploding. The per capita GDP is going up. See, that is the one thing no one really talks about. That because the per capita GDP is going on, a lot more things are becoming affordable. So my advice is very, very clear. Find a good investment, stay invested, ride out the volatility, don't get scared. Look at it from a 30-year perspective, not even a 3-year perspective. 10-year, 20-year, that's the kind of perspective of businesses that you need to find. And anyone who's invested in India for the last 30 years has made out like a bandit. I mean, you've just, increased your net worth manifold just by remaining invested in good quality equities. And I actually firmly believe that the next 10 years will be, India's domain, will be India's time, and we'll have a great many, stronger, more powerful bull markets than we've experienced. So my idea is, with no ifs and buts, buy good quality businesses and remain invested.
Last but one question, then, if the India story is so appealing, and if we've got everything going for us, whether it is on the macro front, earnings front, governance front, or even on the administration front, then why do we keep on getting reports from brokerages which say India is expensive, we are trading above its mean valuation, if the starting point is today, the returns will be compromised?
The last point I will take, the starting point, of course, is important. In any investment, I mean, you could have bought Infosys 10 years at the peak and didn't make any money. But I'll give you the converse case, which I just discussed with a friend, that let's say I was on the floor of the Bombay Stock Exchange and I bought ACC at the then gigantic price of 10,000 rupees. It hit 10,000 at its peak in 1992. Starting from a base of 300. So you figure there's no way you'll make money because then the bear market started and the stock collapsed. But even if you bought it on that day in April 1992 at 10,000 rupees, I think you made 5x your money. I think the stock has gone up 5x from that price, even if you bought the highest price. So as long as you remain invested in great businesses, some of them tend to find a way to make money. Inflation helps because that increases the value of all these assets over time. The rupee keeps depreciating. So that also, helps the value of these assets. So, brokerages perhaps is their business, to, encourage you to churn your portfolio, get in, get out, buy, hold, whatever. I don't know. But that's been the wrong trade in India. The trade in India has to be to remain invested in high quality businesses. And the evidence backs me up. I mean, whether they're right or wrong, I'm not sure. Maybe they'll be right a few times, wrong a few times. But if you kept the Asian Paints or kept the Dr. Reddy's or kept the Castrol's, so rather than try and time the market, try and find the great businesses that you want to remain invested in. So, the evidence is very clear. I mean, there's no dispute about that. The index is up 100x. Now you can keep, saying that this is all very undervalued. The evidence points that if you stay, you'll compound your money at 15-16% per year in the index. I'm suggesting if you pick stocks and pick good businesses, maybe you can move it up to 20-21%. And that's a great payday for everyone.
And before we wrap, I must share with you, these days, Ramesh, you'll appreciate that we're in a digital world and the feedback is instant. And I've got a long feedback and everyone is saying the same thing. Please request Mr. Damani to come more often on ET now. Why is he shying away from all the interview requests? And my guest relation teams, they say that's the time they don't like Ramesh Damani, when he does not agree to a persistent request of interviews.
That is so kind of me, because I really appreciate that. I'm sorry I have been a bit remiss, but I have been involved in a few other things. But we'll make up for that. And I truly wish all of you, your team, and your viewers a very happy and safe new financial year that is about to dawn on us. I think despite the enormous challenges the world faces, the world has figured a way out of this, and I'm eternally optimistic that the human spirit will prevail again.
And thank you for joining us. This interview, I'm sure, will be an interview which a lot of investors would like to play and replay again and again and understand from your wisdom. The bull market is not over. Keep the faith. Buy and hold good businesses. That is the sum and summary of today's interview, that the bull market is not over. Let's say a big yes and then we'll wrap, sir. The bull market is not over.
Absolutely. Very unequivocally, I feel that it's as good a time to buy equity as it was 30 years ago. I mean, you're fine. You just remain invested. The bull market is ongoing, and we will be challenged, because of course we'll be challenged. I mean, we were challenged a few months ago. We'll be challenged again. But the underlying message for the last 30 years is that don't sell India short. I think we're on something special here.